Today, hi everyone. So let me just introduce myself. My name is Michael Valtos. I'm the founder and trader at orderflows.com. And what I'll be talking about today is how to profit in the futures market with order flow analysis. And if you're not familiar with order flow, what it is basically is it's a way to analyze the market based on the volume that's traded. Most traders look at the market on a simple bar chart. They just look at the open, the high, low, and close, and don't really go underneath into what's happening in the market. So order flow will help you if you want to understand the market dynamics, how the market moves low enough to find buyers or encounter price rejection near the lows, or how the market rallies to a level where it's going to find sellers, or if there's going to be price rejection near the highs, which will also cause a sell-off. And order flow will help you if you want to understand the balance and imbalance in the market as a result of the dynamics between buyers and sellers. Now, I just want to preface, order flow is not going to be for everybody. If you think an order flow is going to be, the holy grail that's going to answer everything about, trading, that you're going to pick up order flow and 6 months later you're going to be living on a beach, drinking Mai Tais and phoning in a few trades. It's not. Order flow is not a trading system per se. At the end of the day, you need to still be a trader. You need to think. It's not a red light, green light system, of trading. You still have to use the computer on your shoulders. That's the best computer available to a trader. And it's not 100% accurate. Nothing is in the market. People that will have you believe that every trade is going to be a winner, and it's going to be happy days. Is selling you something that is going to disappoint you. And you can't look into a crystal ball and know what another trader is going to do. You can come up with the best indicator in the world that the trading world's ever seen, and you get a buy signal, but you don't know when the guy at UBS, the trader at Goldman Sachs, has got 5,000 E-minis to sell, over the next 5 minutes, and you just got long, your 5 lots, and then boom, he presses the button and the market sells off 2-3 points against you. You don't know when that's going to happen, but with the order flow, you can understand what's happening and pick up on it and react to it. So what I'll be discussing today is quite a bit, but I'll try and keep it brief. How to become a consistently successful trader using simple order flow tools, how to know when a market has stopped declining and is ready to advance strongly, how to get the odds in your favor before taking a trade, how to trade on the right side of the market, how to develop patience and market discernment, trade with the smart money and avoid being the dumb money, and trade price action and price patterns, and minimize the use of lagging indicators. These are basic things that basic 101 trading 101 instructions, but when people are just trading with normal charts, sometimes they lose track of this stuff, and they can't. They don't know how to be on the right side of the market. They don't know when the odds are in their favor, and it's very difficult at times to understand when a market has stopped its move and it's going to start another move in the opposite direction. But before I get started, since I'm a futures guy, and there are rules and regulations, and a brief disclaimer: this presentation is for educational and informational purposes only, and should not be considered a solicitation to buy or sell a futures contract or make any other type of investment decision. Futures trading contains substantial risk and is not for every investor. And an investor could potentially lose all or more than the initial investment. Risk capital is money that can be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. Now, it's again, you're trading with. Don't trade with money that you need for your child's college education. Don't trade with money you need to pay your mortgage. It should be money specifically put aside for trading. I mean, it sounds simple, but you know what? Sometimes people don't understand, and with that attitude, it puts extra stress on you as a trader that is going to affect your trading. Now, before I jump in, I know a lot of people here are already familiar with me, but for those that aren't, I just want to give you a background and explain who I am and where I come from and why I do what I do. I got in the industry in 1994. I started on the CME floor when it was still a trading floor. Back then you could just basically go down to the floor, grab someone, ask for a job, and get in. Mine was a little bit more intense than that, but nowadays it's difficult to get into the futures industry unless you come out of a top-rated school with a PhD or a math degree. But you know what? Now you can trade for yourself. I mean, margins have come down a lot. Commissions have gotten down to about as low as they can go. So the barrier to entry now is much lower than it was 20 years ago. And I left the trading floor when electronic trading started taking off, and I moved upstairs to the off the floor trading desk. In '97, I joined EDF Man, which is a big commodity trading company out of the UK. And the year after, I joined Commerzbank, the big German bank, and their upstairs trading desk in Chicago when they started it up. After September 11, I took some time off, and then a few months later I joined Cargill on their futures trading desk. Now Cargill, if you're not familiar, is a massive privately held company in the United States. It's probably the top privately held company in the United States. They got offices all over the world, and they're big traders. They account for about 25% of U.S. grain exports, 30% of meats processed in the United States. They supply McDonald's with 100% of their cooking oil. So, they know the entire supply chain. That's where I really got the good grasp on supply and demand. In 2004, I moved to Singapore. I set up a trading desk in Singapore for Cargill. In 2006, I joined JP Morgan as a vice president of futures trading, and until 2013, when I retired, started my family. And after about a year and a half of a break, I started orderflows.com to work with other traders, people that wanted to get into trading, but didn't know where to start. I had friends that always asked me, "Hey, teach me how to trade, because I've been trading by myself, and they also want to do it. They like the freedom that trading provides. Now, again, I don't give you my history to brag or anything, not in the least. It's I just want you to know who you're learning from, who's teaching you. I mean, do you want somebody that's basically self-taught themselves? They read a couple books on trading, and all of a sudden they put themselves out as a market expert, or somebody that actually earned a living. This is what I did to pay for my house, pay for my car, put food on the table, clothes my kids, put clothes on myself. If I wasn't good at it, I wouldn't have lasted as long as I did. So again, if you're going to surgery, who do you want to operate on you? Somebody with 20 years experience, or someone just out of medical school with very little experience, but just practice on cadavers? It's one of those things where if you're just practicing, you're learning from somebody that practiced. If they make a mistake, well, it's just paper money. But when I was trading before, if I made a really bad trade, it'll affect my pay. It'll affect my bonus down the line. So now that's out of the way. Let's jump into order flow. Before I get started though with a bunch of charts, I do want to go over some terms which, for some people they may not understand, but when you see that order flow chart, everything will really fall into place. So there's just a few terms that order flow traders use. This point of control, also known as POC, which is the price level in a bar with the most volume. And why that's important is because oftentimes it can act as support or resistance in the next bar. If you're looking at a bar chart and you see how price comes down to a certain level and then moves away from that, oftentimes it comes down to that point of control. That's the support or resistance. A bullish ratio and a bearish ratio in order flow analysis, for a bullish ratio it indicates a bullish sign. For a bearish ratio, it indicates a bearish sign. Imbalance is when the ratio between buyers and sellers is out of line. A buying imbalance occurs when aggressive buyers dominate a price level, and selling imbalance is when aggressive sellers dominate at a certain price level. Stacked imbalance is when you get aggressive buyers or sellers at consecutive price levels in a bar. Again, it'll make a lot more sense when I show you some charts. And a few more terms. Delta is the volume difference between buyers and sellers in a bar. A positive delta is the net buyers in a bar. A negative delta is the net sellers in a bar. And the divergence in order flow is when you have a new or equal high with negative delta, or a new or equal low with positive delta. All right, so let's get started. So become a consistently successful trader using simple order flow tools. So yeah, ask yourself, what's the number one problem that you face? I know that dealing with a lot of traders, one of the problems that they face and people that I've dealt with is that they tend to make things complicated. They jump from indicator to indicator, moving averages, Bollinger Bands, RSI, DMI, MACD, etc. And it gets to a point sometimes where they think, the more I have on my chart, the better. Something's going to have to give me a signal. But you know what? You're just killing yourself, by looking at too much. Think of it like when you drive a car. You got a lot of instruments. You got the tachometer, oil pressure, tire pressure, speedometer, odometer, coolant pressure, coolant temperature, and others. But what's the one thing that you look at most is the speedometer. You don't care about tire pressure. There are times that you do care about it, but in general, you're not monitoring it, as you're driving along. So, if you find one thing to focus on, then it's going to make your life a lot easier, and that's where order flow comes in. It's going to make your chart a lot cleaner and your analysis a lot easier. So, a lot of people, they send me charts. So this is my chart for just crude oil, but they got so many different charts on indicators on here. Something's got to be right. I mean, at this point, you might as well just be throwing a dart against the wall. But with order flow, you have a nice, simple, clean chart, but there's a lot of information. It doesn't look like much at first, but once you understand what you're looking at, it makes perfect sense. You have your candles. You're up. Green candles is up. Red candles are down. The point of control that I talked about earlier is the price level with the most volume in the bar, and the order flow chart will put a box around it. If you have an imbalance, it'll be a buying imbalance will be blue numbers, a selling imbalance will be a red number. Just a normal volume at a price level is black. Then your bullish ratios will be in blue. A normal ratio will be black, and if it's for a buy, it'll be below. Sorry, for an up candle, up bar, it'll be below. But for a down candle, a red bar, it'll be above. There's no bearish ratios on here, but you'll see some in a second. And there's just a lot of information on here that you could only get by looking inside the bar of what's happening in the market. So you can see who's in control, if anybody's in control, if you've got support or resistance happening, at a certain level, and it just gives you a lot more information than a normal bar chart. Looking here, gosh, that looks like a MTV explosion. Okay, so keep it simple. So another way order flow will help you is it'll help you how to know when a market has stopped declining and is ready to advance strongly. A big mistake that traders make is they're trying to predict what the market will do next. What you should be doing is reacting to what the market's doing. If you're trying to predict the bottom, you'll get burned. Instead, what you should be doing is trying to read what's happening in the order flow as you're coming into a bottom and you start to move away. And you can see here, okay, see this is a bearish ratio, it's in blue. This one here is black, so it's just a normal, your normal everyday order flow. It's not that order flow is going to help you predict every single turn in the market. It's not. Again, if you think it is, I hate to burst your bubble, but it's not. But what it's going to do is going to give you insights into certain points in the market where it could be turning, or a move could be stopping, or you could be running into support or resistance. Again, it's not going to give you every single turn in the market, so don't think it is. But you can see here, we're coming in. This red line is the low of the day. We're coming down, making new lows, and you got a few things here. You've got a divergence that's a new low with positive delta. You've got a bullish ratio, point of control is near the bottom of the bar, and even in the bar before, it's got a lot of volume, but the delta is still kind of small. So we're coming down here on less total net selling, and it turns here, it's positive, and you see the market rallies from here. This is one of those slam dunk trades that anytime you could get something like this, it's a very high percentage trade. This is a top forming, and we're turning down. In this case, it's a little bit different. There's a lot of different ways to analyze the market with order flow. If you're just using, MACD or RSI, you're only looking at one certain thing. Whereas order flow is going to give you, many different things that you can use in your analysis. And So we hit a high. This green line is the high of the day. So we hit a high. The first time we got a divergence, we got a bearish ratio. We come off a little bit, come back up, we test a high. Sometimes the market's going to test a high or a low, and again, you got a divergence. You got net selling at the high of the day, and you've got another bearish ratio here. So again, and the other important thing is you test a high with lesser volume, so the volume on the way back up is dying. It's not as strong the second time. And then we try to do a third time, okay? And we get back up here, we get within one tick of the high, but really, the big sign was this one. We're testing this high again on a lot less volume, so the move, there's not much left in it. And then, people try it one more time, and they can't even get up to that high, and then the market falls off all the way, and we make new lows even. I mean, it's not every time it goes from the high to the low, but you know what? There are nice moves to be had in the market. Okay, now another way order flow will help you is get the odds in your favor before taking a trade. If you've ever been to Vegas, you know who makes the money, right? It's the casinos. Why? Because they have the odds in their favor. Overall, odds are in their favor. Now, there may become a time when a big high roller comes in with a bankroll is willing to bet $5 million, over the course of a night, and the casino loses money. Maybe they drop $2 million. Okay, but they're fine with it because they know over time they have the odds in their favor that they'll come out ahead. It's not that every single day they're going to make money, just as in trading. Yes, every day you would like to end up in the plus side, but there's going to be times that you do have losing days. Again, I don't want to burst your bubble, but keep a foot in reality, right? Nothing is 100% certain in life except death and taxes. And so, when you have the odds in your favor, it's going to help you take better trades. And what do I mean, the odds in your favor? Is when you get a few, a convergence of order flow analysis, all pointing to the same thing. And, here we have a high, we have a divergence here. Okay, but, it's not a bearish ratio because it's a high. And then the market comes back up and it tests it. And now we've got the ratio, the bearish ratio here, right off the high. So we know we couldn't hit the high, and you're seeing, some signs of price, price rejection. In this case, this is resistance up here. And then what happens over the next few bars? The market sells off. Okay, this is a slightly different example, but again, this is an example where you have, this is from just last. All these charts are just within the last few trading days. Okay. So we hit a high here. We have a divergence. Nothing in the else other than the order in the other than the divergence is giving you a sign that this high is going to be the high, and you even come back up and you test it. Then you hit this new high. Again, you got a divergence. This time you have a bearish ratio. You've got some big selling imbalances in here, 2,800. Then you have a nice stacked imbalance in here. So if you weren't convinced in this bar, you should be convinced already. And again, we make this move from 161, 151 down, down to new lows at, below 150.20. This is how, putting the odds in your favor is when, the order flow is screaming at you, hey, this market is heavy. It's gone from a demand-driven market on the way up to a supply-driven market. That's the time to get short. Okay, now everyone always says, you got to trade on the right side of the market. Yeah, obviously, of course. I mean, you don't want to be swimming against the current, right? Because you'll just burn a hole in your account. But it sounds easier. It's easier said than done. I mean, it's easy to say, yeah, you got to trade on the right side of the market. But sometimes people don't know which direction we're going. Here's a case of a market going higher. Now, every time you go into highs or into lows, you want to know, are we going to keep going higher, or are we going to come off? Or if we're going into lows, are we going to keep going lower, or we're going to bounce? And imbalances, is a great tool that you can use to determine, whether a move is going to continue or it's going to stop and reverse. And, we're going up here, up, right on the high. You got a selling imbalance. So where are the buyers? You don't have them here anymore. All of a sudden, now it's just stacked with sellers. You got aggressive sellers at 3 price levels right there, and we make a nice little move lower. This is what you call, everyone talks about, oh, you got to take trades with low risk. They don't really tell you how to get them. If you have this stacked imbalance like this, your stop is just right on the other side of it. And, your potential is, from the high. If this is going to be the high of the day, obviously, there's market, you got a high of the day or the low of the day. And, how often have you seen, the market hit the high of the day and sell off quite dramatically, or hit the low of the day and rally quite dramatically? So, if you could have a solid reason with a tight stop off a high or a low, those are sometimes the best trades that you can get. And that's order flow is something that's going to help you. It's if you're trading a moving average, by the time you get in, you're in somewhere down here because your average would trail here, and by the time you get in, where's your profit potential? There's not much there. But order flow, you can see it instantly as it's happening and jump in. Now, another way imbalances will help you is, if the market's going sideways, right, you want a sign that, hey, we're going to come out of this sideways action and make a move in one direction or the other. And this is a perfect example. We're just going sideways here. All of a sudden, you got stacked imbalance right here. Okay, it's a pretty good sign that the market is finally taken over by the buyers, and it's going to go higher, and it does. It acts as your support level. And you can see the market, it came in and tested those levels where you had the aggressive buyers there, didn't spend much time down there, and just went higher. Now, this is, again, it sort of follow up what I said earlier about, when you go into highs and lows, you want to know, are you going to keep going higher or are you going to keep going lower? And, when you're going into highs with aggressive buying and you have buying imbalances, it's usually a good sign that the market's going to go higher. And here you got stacked imbalance here, and it's followed up with another stacked imbalance here. And you can see it just keep shooting higher. Buyers are just dominating this market. They grab the market by the neck, and everyone is jumping in and running in, take my money. I can't buy enough S&Ps, and we're screaming higher. This is the information that order flow is going to give you. Now, if you're trading with an overbought, oversold indicator, everyone, you get to overbought, everyone's looking to get short. Well, the problem with that is, what do you do when the market goes to more overbought, then extreme overbought? If you keep shorting it, you're going to be sucking wind. But if you're reading the order flow, you know that, hey, even though the indicator says, overbought, there's still a move going to happen here. It's still very good buying in there. Now, this is a rarer occurrence, but it does happen. This was on the 26th, just the other day. This is on an E-mini 5-minute chart, and this is how order flow is going to help you as a trader, with some of your trades, because when you get into a trade, you should have a stop, right? So your risk on the trade, what you're willing to risk. But one of the problems is always letting the market stop you out without reading the market and understanding that the whole reason for you getting short is no longer there. So if you get short, then the market gives you a sign that the reason for being short is no longer there, and in fact you should be long. You could get out. You could get out and scratch your trade, take no loss, or maybe lose a tick or two, or who knows, maybe make a profit of a tick. But that's what order flow is going to help you with. If you're just using regular charts or regular indicators, you're not going to know that the supply and demand has changed. And you can see here you got a stacked imbalance, which is very bearish. This is 1, 2, 3, 4, 5 levels. That's very bearish. But what happens? You get short in the next bar. But what happens in the next bar is it comes back with a stacked buying imbalance and some very strong numbers. So the whole reason for being short is thrown out the window. So if you get short in here and you got to stop up here, why you don't need to wait for it to come all the way up here to stop you out at a full loss. You can get out in here over the next bar, for a scratch or maybe a small loss, or maybe even if you're good at finessing things, maybe a tick profit. But sometimes you try to finesse things and you finesse yourself into a bigger loss. But nevertheless, what you can see here is the market changed from a supply-driven market to a demand-driven market. Now you got buyers just really stepping up at these levels. As the market's coming down, it's looking for a level where buyers are going to step in and be aggressive and take control of the market. And it found its level down in here, and it came back up here with all these very strong buying, and it's continued up. So that's how order flow is going to help put you ahead of 90, 95% of the other traders out there. I mean, it's no secret that 90, 95% lose money. Well, why do they lose money? Is because it's they make bad decisions and they can't tell when the market's changed against them. If you've ever traded with fundamental analysis, when your analysis of the fundamentals change, you get out of the trade. You don't sit there, well, my analysis changed, but I'll just let it stop me out. No, of course not. You get out, and either you reverse or you just get out. But if the initial reason for being in the trade is no longer there, then it's time to get out of the trade. You don't have to let it wipe you out, but go to your stop price and take the full loss. Again, if you could get out with a scratch rather than a punch in the face, you get out with the scratch. And order flow will help you develop patience and market discernment. Now, what I mean by patience is, again, I'm not saying that you're going to develop the patience of a Calvinist monk, spurning every temptation of flesh out there. As a trader, in slow markets, sometimes you're just trying to reason yourself into a trade. But with order flow, it's pretty concrete whether you should be into a trade or not. And this is a market, we hit a low, and then we're just going sideways. Okay, well, at this point, you're thinking, you're coming here, well, are we going to go higher? Are we going to go lower? What should I do? And you're looking for a sign one way or the other. Points of controls are kind of bunched up here within a point of each other, so there's not much movement. And then boom, you get a nice stacked imbalance, and so you got your sign that the market is ready for a nice rally. Okay, so and then boom, you get it. Then you got the stacked imbalance is acting as support now, and we're just going higher on up. And then same thing here, right? There's another 5-minute chart. If you watch 5-minute charts, there's going to be times where it just looks like the market's flatlining on you, and it's hard to make a decision one way or the other when a market's sort of flatlined on you. You want to look for a reason in the order flow that the market's getting ready to make a move. Start selling off or rally, and so here, very tight range. Points of controls all around the same level. And then you start seeing in the imbalances 1300, 600, 1700, 1700, and then wham, you get slammed right here. You got a stacked buying imbalance, 500, 1300, 1100. That's your sign that, hey, sellers are stepping in here. They've overrun the buyers. All these people that were bidding these levels down in here, offering support, they're gone. They just got run over by the sellers. And then what happens? Then we sell off. We make this move from 63 area down to 57, 57 and a half. Very dramatic. Not much of a bounce back up. And we got a little bounce here. It's still under pressure on the way down. Okay, now you hear this a lot. Trade with the smart money, avoid being the dumb money. You hear that so many times. So many people say that, especially people that are out there, other vendors. They don't really say who the smart money is. They assume that it's the hedge funds, that it's the algos, but it's really not. The average life expectancy of a hedge fund is like 5 years. Do the research. I mean, I could pull it up. I mean, there's a Financial Times article not too long ago about it. But if a life expectancy of a hedge fund is 5 years, the average hedge fund lasts 5 years. That's not really very smart. And these algo firms, everyone talks about high-frequency trading. A lot have gone under. They can't meet their payroll because they're just picking up crumbs in the market. Is that smart? Well, yeah. I mean, if you're a big firm like Virtu that's got billions of dollars behind you, yeah, you can pick up immense amounts of crumbs that you can make, a loaf of bread. But for a lot of algo firms that are just got, a couple $1 million on the management, picking up crumbs, you're talking, small amounts of money over the course of the year. You can't meet payroll. But who's the smart money then? Well, it's the smart money are the big commodity firms, like Cargill, Bunge, ADM, Dreyfus, Stat Oil, Chevron, even Exxon. The big commodity firms that have been around for hundreds of years. Literally, EDF Man was in the 1700s, trading sugar. Dreyfus, the 1800s, trading coffee and cocoa. Cargill, obviously, grains. And you don't last 150 years unless you're good at trading. And the reason they're good at trading is because they have access to information that the rest of the free world doesn't have, because they know what's being planted, they know what's being harvested, they know what's being crushed into product, they know what the end users are buying, they know what's in the water, like in the tankers, what's being shipped where, and what's being delayed. So they have a better grasp of supply and demand than most traders sitting outside of those trading rooms are going to have. Now, how do you tell what smart money is doing? Well, the problem is these smart money, for them is their size is so big that to move their positions, it's going to show up in the order flow, and oftentimes, it's going to show up with heavy volume, and oftentimes in terms of imbalances. So again, you're looking at this bar here, you've got some quite big imbalances: 1300, 1600, 1300, 3000, 1100, 3000. And what happens? The market, boom, the bottom just falls right out. Another example, big volume can indicate big supply or big demand. So here you have a market rallying up, right? And so when you're rallying, right, it's a demand-driven market. Demand is there to drive the market up. When you get up to this level, you've got a bearish ratio. It's indicating, the market is got some decent volume up here that we can start to, possibly make a turn and go lower. And then, what do you got? You're getting up here near the high, and you're seeing, what's being traded on the offer: 1500, 2900, 2300. On this way up, where's that volume? You don't have that type of volume being traded. Down here you got 4,000, but up here on this way up, other than this one level, 3,500, which is still a level that we're trading, in this next bar, up here at this high, you see there's a lot of sellers up here. Okay, so if you're a commercial, and the price gets to a certain level, you've got inventory that you can move, and if you've got inventory you can move at those higher levels that you've got, from a week ago or a couple weeks ago when you're lower, you're happy to sell it. That's what causes imbalances. That's what causes stacked imbalances. That's what causes the markets to sell off. Is when the commercials come in. The commercials, the big trading firms, those are the ones, the real money accounts, those are the ones that cause trends to happen, and moves to end and new trends to start. So, the last thing I want to touch on, I got about 10 minutes left or so, is, or not even, price action and price patterns to minimize the use of lagging indicators. I should have made it pretty clear by now, how order flow is going to put you ahead. But even in order flow, there are certain patterns that reappear, that repeat themselves over time. And they appear again and again. This is what I call the 3 in a row, 3 bearish ratios. 1, 2, 3. You get a little bit of a pullback up to the point of control, which is going to be acting as your resistance. When I talk about point of control being important, you can see if you're making a move lower, the point of control of the bar is going to often be the resistance in the next bar. And you can see, okay, point of control here, we rally back up, got within a tick. This one right up to the tick. This one right up to the exact same level. This one tick through. These two side by side. This one tick below. So you can see your resistance on the way down. So you have those levels to hide behind if you're short. But this is a pattern. There's patterns. Go to my website. I talk about a lot of patterns in there. So order flow, by now, you should understand, provides you with the tools to, 1, identify a trade, execute a trade, and manage the trade. Those are 3 very important parts of trading. It's a lot of people focus on identifying trades, but that's only one piece of the puzzle. You have to execute it. You have to understand that why it's happening, and have the conviction behind you to take the trade. Then once you're in the trade, you got to manage it. Are things changing? Are the conditions changing in the market that you should stay in the trade or you should get out? So order flow provides you with a decision-making process for your trading approach that allows you to monitor and react to opportunities as they occur, right? It's depending on how you trade, order flow can help you, whether you look at minute charts, range charts, Renko charts, order flow can help you in your own trading style. I don't expect people to go out there and copy how I trade and trade basically be a clone of me. Everyone trades differently. I mean, you could read the book Market Wizards. 20 traders in there. Each person has their own trading style, but they're all successful. So, there's two ways you can learn order flow. You can learn the slow way, through trial and error and some of what I explained today, or you can do it the fast way using the Order Flow Trader software package that I put together. Who do you want to be? You want to be the guy putzing around trying to put the pieces together, or the guy that's got his shit together and is driving the nice car. And what is the Order Flow Trader software package? Well, it's the Order Flow Trader software which generates the charts you saw in this presentation and plot the order flow and does order flow analysis for you, puts the ratios, puts the divergence, puts the imbalances, puts the stacked imbalances on there, and a few other little things. But if you go to my website, you can learn more about it. And I also give you the order flow trading course, which is 20 modules. It's a 15-hour video course that no matter what your experience is in order flow, beginner or advanced, you will learn something, I'm sure, that you probably never imagined that you would have thought of with order flow. And the reason I include that in there is because people spend thousands of dollars, literally. I know some packages cost $5,000 and up, but they don't get the training. They don't teach them really what's happening in the market, and that's why I created this course. I didn't imagine it would be 15 hours. I was thinking 6 hours, but once I sat down and started putting it all together, I realized it's going to be a lot longer than 6 hours. But you know what? If you do a Netflix binge type thing, you get it done in a weekend. But generally people take their time, and over a week or so, they're able to watch it all. And as a bonus, I'm going to give you 3 indicators that I use. I've just came out with the U-turn, transition, and the flip. These are order flow indicators. They read the order flow and highlight what I like to think of low risk trade entries. Now, I don't leave anything out. Whether you're new to order flow or you're a junkie, it's going to help you. Now, these are the indicators. I'm going to go through just a couple quick charts. They can run on an order flow chart, which I think is the best. But some people like to still use bar charts sometimes and refer back. They will also run on a bar chart. This is the flip, and each indicator reads order flow in a different way. So you can see a buy signal here, a buy signal here, a buy signal up here. This one's a little bit late, but it's a confirmation from if had you been long earlier. Another one is this is the transition. So you can see when a market is transitioning from a supply-driven market to a demand-driven market. As you're coming down here, you get a buy signal here, you get another buy signal here, another buy signal there. And the last one, the last indicator is what I call the U-turn, which often picks turning points in the market. It's not always 100% right, because you don't always know if the bottom has been made. I said, there could be somebody sitting at a trading desk that's got an order to start executing. But it's pretty good. This is a nice little move here. I'm not saying you would have caught that. This one, depending on what sort of stop you got, that's a nice move. This was a sell signal here. You got a nice buy signal there. Now, the software runs on NinjaTrader, which you can download for free at ninjatrader.com, and it reads this volume traded on the bid and the offer and puts it in an easy-to-read volume footprint chart. I have my own style of trading program so that users can trade order flow based on my trading experience. So the question is, how much is it going to cost me? Normally, I sell the software, just the footprint chart software by itself, for $8.99. The order flow trading course I sell for $2.97. The 3 indicators as a package I normally sell for $600. This is the exact same package that I sell on my website for $1,250. But today, because of Investor Inspiration welcoming me here, I'm going to give you guys, the chance to pick it up for $900. So it's a nice savings. Again, I'm not out there to grab people's money. I make a little bit of money doing this, but it's really about trading for me, and getting people to learn how to trade. You know, I mean, if you can learn how to trade, you know, you have a skill that you can take with you no matter what. I mean, you know, you lose everything and, you know, you go through a nasty divorce or whatever, but if you have the skills to trade, you know, that's a skill that they can't take away from you. So right now, how to take advantage of it is you go to this page, www.orderflows/deal.com. This is what it looks like. You just scroll down to the bottom. It's called, look for this button that says Let Me In. Click on it, and it'll take you to the payment page. You know, it's done through PayPal. I don't get your credit card information. I don't want your credit card information. You know, it's a third-party processor. So, you know, most people are familiar with PayPal. If you ever bought anything through eBay, you got to use PayPal. But you know, if you're one of those people that, you know, is old school, don't like give credit card information out online, that's fine. You know, just message me, and you know, we could always work out alternative forms of payment. You know, I got customers in the Middle East. They like to send money, you know, by Western Union or bank transfer. I don't discriminate in that sense. And you know, again, you know, it all starts with taking action. You know, you could do it slow, trial and error, and you know, maybe apply some of the things. You know, watch this webinar over a couple times and understand what I was talking about with imbalances and ratios and point of control. Or you can do it quickly and use the order flow trader software, the course, and the indicators. You know, again, is order flow for everybody? No. I mean, if you're coming in here thinking it's a holy grail, it's going to solve your trading problems in the next 24 hours, it's not. You know, it's a skill that you can learn that, you know, once you understand it, once you have it, you know, you can take with you everywhere. I mean, everybody uses order flow in their everyday life. You go to the grocery store, something's on sale, you're encouraged to buy it. You know, that's buying below the value of something. If it's priced too high, you're not going to buy it unless you really need it. You know, it's priced outside of value. You know, so we all use order flow. Sometimes we just don't even realize it, and we'll use it in our everyday life. So, you know, thanks for watching. Again, you know, the website to go to is orderflows.com, but to take advantage of the deal, you know, this deal is not going to last, you know, for months. It's just going to be a very short-term thing. It's orderflows.com/deal.html. Any questions, shoot me an email, mike@orderflows.com. But, you know, just, you know, again, you know, give me a chance to reply. You know, it may not be within an hour, it might be a day or so, but, you know, I tend to reply to everything. Some people beg to differ. But, you know, if say you already have an order flow software and you just want to learn more about order flows, that's fine. Go to my YouTube channel. I've got a lot of videos on there about order flow analysis, you know, trade recaps that you can watch and see what I was going through in my thought process with the order flow. You know, subscribe to the YouTube channel so when I post a new video up there, you know, you get a message saying that, you know, a new video has been posted.